next 6 months to a year. As I said, bulls can be secure in knowing once again that moral hazard's downside has been cast aside in favor of its upside. I was not happy about this. America had chosen its poison as its cure. But being as practical as I could, and as practical as I had to be as a fiduciary, I thought it was time to buy, and I said so. And my investors once again thought I was insane. So I shut the funds down. I felt I needed to be physically mobile and private in order to navigate the coming years. The headwinds from investors would be a hindrance to what I felt I needed to do. Having experienced the returns decimating revolt of my business partners over my housing short, I knew I did not need that static in this new environment. After closing the funds, I laid low, and in the early part of 2009, I continued on privately with my investments in equities and to a lesser extent farmland and gold. I made investments I could never make with the investor base and business partners I had at Zion Capital. So today I expect the U.S. government to, let's look forward a little bit. Today I expect the U.S. government to attempt to continue these easy money policies into 2013. This will take us in the next presidential term, past the meat of most of the foreclosure crisis and the corporate and public refinancing crises which are upcoming. We're looking at more than $5 trillion in private sector debt needing to be refinanced during that time. But this is a gamble as we continue to debase our currency. The clear risk is that the Treasury's auctions begin to fail and purchases by the Fed, by the primary dealers, by the nation's pension funds and such cannot make up the difference. In fact, QE2, in my opinion, raises at least the question of the Treasury's needs. To sum up, my feelings today are that the U.S. is in a precarious position. The government's borrowing of money for the purpose of injecting cash into society, bailing out banks, brokers, and consumers, is a short-sighted, easy decision for a population that has not yet learned that short-sighted and easy strategies are the route to long-term ruin. We never quite achieved the necessary catharsis to stoke a deep reevaluation of our wants, needs, and fears. Importantly, the toxic twins of a fiat currency and an activist Fed remain firmly entrenched, even more so with the financial reform earlier last year. This gets to the economics and policies that got us into this mess. It strikes at the heart of strong efficient markets theories and blows holes in the risk measures derived from that. In fact, if we consider it, the whole of economics as practiced by America's leaders, regulators, and top business school professors is born of the Great Depression and various views on how to deal with the Great Depression. The concern is never how to prevent the downturn in the first place from being so severe. And this is where I think economic thought in America goes all wrong. There is a line of thought that absolutely predicts these sorts of events and advocates for a more hands-off approach as far as government's involvement in managing business cycles. It is more aligned with the Austrian school, which was rejected long ago by our politicians and intelligentsia. They rejected it back in the 1960s, around the time they rejected the idea of a liquidity trap, and also around the time when JFK decided it was a good idea to finally allow government employees to unionize against taxpayers, which is blowing up right now. The politics of today say, get us out of this mess fast. By